The 16th largest bank in the United States collapsed in 48 hours. Silicon Valley Bank held $212 billion in assets on Wednesday, March 8, 2023. By Friday morning, March 10th, the bank was insolvent. The California Department of Financial Protection and Innovation seized control and appointed the FDIC as receiver. The second largest bank failure in American history happened faster than anyone thought possible. But here's what makes SVB different from every other bank collapse. It wasn't caused by fraud, reckless lending, or criminal misconduct. Silicon Valley Bank failed because of interest rates. The Federal Reserve raised rates to fight inflation, and those rate hikes destroyed SVB's bond portfolio, creating unrealized losses the bank couldn't survive once depositors panicked. The collapse was entirely predictable. The warning signs were obvious for months, but nobody acted until it was too late. And when the panic started Wednesday afternoon, the speed of the bank run in the digital age made rescue impossible. By Thursday evening, venture capital firms were telling their portfolio companies to withdraw funds immediately. By Friday morning, SVB was gone. This wasn't a slow-motion disaster like Lehman Brothers or a hidden fraud like Bernie Madoff. This was a bank that looked healthy on Tuesday and was dead by Friday. The collapse triggered immediate contagion. Signature Bank failed Sunday, March 12th. First Republic would follow in May. Regional banks across America faced deposit runs as customers questioned whether their bank was next. The government was forced to guarantee all deposits at SVB and Signature, breaking the FDIC's $250,000 insurance limit to prevent systemic panic. This is the story of how Silicon Valley Bank became the fastest major bank collapse in American history, how the Federal Reserve's interest rate hikes created a ticking time bomb in bank balance sheets nationwide, how venture capital concentration made SVB uniquely vulnerable, and why the speed of digital banking turned a manageable problem into a catastrophic failure in hours. Understanding SVB matters because it revealed a systemic weakness that still exists across the banking system. Hundreds of regional banks hold similar unrealized losses on bond portfolios. Interest rates remain high. The conditions that killed Silicon Valley Bank haven't gone away. They're just waiting for the next trigger. Silicon Valley Bank was founded in 1983 in San Jose, California, specifically to serve the technology and venture capital ecosystem. The bank's founders saw an opportunity. Traditional banks didn't understand startups. They wanted collateral, predictable cash flows, stable revenues. Startups had none of those things. They burned cash for years before profitability, if they ever reached profitability at all. SVB built a different model. The bank offered banking services to venture-backed companies and the VC firms that funded them. Startups deposited their venture capital funding at SVB. VC firms kept their fund accounts there. Wealthy tech founders banked there personally. The ecosystem was tightly integrated. By 2023, SVB served nearly half of all U.S. venture-backed startups. This concentration was both SVB's strength and its fatal weakness. When the tech sector boomed, deposits flooded into SVB. From 2019 to 2021, during the COVID pandemic and the tech bubble it created, SVB's deposits exploded. In 2019, SVB held $62 billion in deposits. By March 2022, deposits had nearly tripled to $189 billion. The surge created a problem. What do you do with all that money? Banks make money by lending deposits to borrowers and earning interest on loans. But SVB couldn't lend fast enough to absorb the deposit flood. Startups were raising massive rounds and parking hundreds of millions at SVB, but they weren't borrowing. They were spending venture capital, not taking loans. So SVB did what banks typically do with excess deposits, bought bonds, U.S. Treasury bonds, and mortgage-backed securities backed by government agencies like Fannie Mae and Freddie Mac. These are considered ultra-safe investments. They pay modest interest, but they're liquid and supposedly risk-free. SVB invested heavily in long-duration bonds that mature in 10, 20, even 30 years. The longer the duration, the higher the interest rate, so SVB locked in higher yields by buying long-term bonds. By the end of 2022, SVB held over $120 billion in bonds and mortgage-backed securities. Roughly half the bank's total assets were tied up in these investments. Here's the critical problem. Bonds lose value when interest rates rise. This is fundamental to how bonds work. But many people don't understand the mechanism until it destroys them. Imagine you buy a 10-year U.S. Treasury bond that pays 2% annual interest. You paid $1,000 for the bond, and every year you receive $20 in interest payments. The bond is safe, backed by the U.S. government, and in 10 years, you'll get your $1,000 back. But what happens if, 1 year later, the Federal Reserve raises interest rates and new 10-year Treasury bonds are issued paying 5% instead of 2%? Your bond is now paying $20 per year, while new bonds of identical risk and maturity are paying $50 per year. Nobody wants to buy your 2% bond when they can get 5% elsewhere. If you need to sell your bond before maturity, the market value has fallen dramatically. To make your bond competitive with new 5% bonds, the price has to drop enough that the $20 annual payment represents a 5% return for a buyer. Your $1,000 bond might now trade for $600 or less. You've lost 40% of your investment, even though the bond is still perfectly safe and will still pay back $1,000 at maturity, if you can hold it that long. This is the trap that destroyed SVB. The bonds weren't risky, they weren't fraudulent. They were U.S. Treasuries and government-backed mortgage securities, the safest fixed-income investments that exist. But SVB bought them when rates were near zero and held them when rates spiked to 5%. The market value collapsed. SVB bought most of its bonds in 2020 and 2021, when interest rates were near zero. The Federal Reserve had cut rates to stimulate the economy during COVID. Bonds were paying 1% to 2% interest. SVB bought billions in bonds at those rates, locking in long-term investments. Then, in March 2022, the Federal Reserve began raising interest rates aggressively to fight inflation. By March 2023, the Fed had raised rates from 0 to nearly 5% in 1 year, the fastest rate hike cycle in decades. Every rate increase hammered the value of SVB's bond portfolio. By early 2023, SVB was sitting on approximately $15 billion in unrealized losses on its bond holdings. The bonds weren't worthless, they would still pay back at maturity, but if SVB had to sell them before maturity, the bank would crystallize massive losses. As long as SVB held the bonds to maturity and depositors didn't withdraw funds, the unrealized losses were just a paper problem. But if depositors started pulling money out, SVB would be forced to sell bonds at a loss to cover withdrawals. That would turn paper losses into real losses. The bank's executives knew this was a problem. Internal documents show SVB management discussed the interest rate risk and unrealized losses throughout 2022. But they believed deposits were sticky. Tech companies needed operating accounts. Venture capital firms had long-standing relationships with SVB. Depositors wouldn't flee en masse. The unrealized losses would eventually reverse when bonds matured. SVB just needed to wait it out. They were catastrophically wrong about deposit stickiness in the digital age, and they underestimated how fast venture capital panic could spread through a tightly networked ecosystem. The collapse began Wednesday, March 8, 2023. SVB announced it had sold $21 billion in bonds, crystallizing a $1.8 billion loss. The bank simultaneously announced plans to raise $2.25 billion in new capital through stock and convertible bond offerings to shore up its balance sheet. Wall Street analysts immediately panicked. Why would a healthy bank need to raise emergency capital? The bond sale and capital raise signaled distress. SVB's stock price fell over 60% in a single day. Venture capital firms started getting nervous. Then the bank run started. Not a slow trickle of withdrawals, an avalanche. By Thursday morning, March 9th, venture capital firms were sending memos to their portfolio companies. Withdraw your funds from SVB immediately. Move money to JP Morgan, to Wells Fargo, to Bank of America, anywhere but SVB. The panic spread through modern communication channels at unprecedented speed. VCS posted warnings on Twitter. Founders texted each other. Slack channels for startup communities exploded with urgent messages. Get your money out of SVB now. Portfolio company CFOS received identical emails from multiple investors simultaneously, all saying the same thing: withdraw. In previous bank runs throughout history, panic spread through physical proximity. People saw lines forming at bank branches and joined them. During the Great Depression, newsreels showed crowds outside failed banks. In 2008, customers lined up outside branches of Northern Rock in the UK and IndyMac in California. The physical manifestation of panic was visible and took time to spread geographically. SVB's bank run had no lines, no crowds, no visible manifestation at all. It happened entirely electronically. Depositors logged into online banking platforms and initiated wire transfers with a few clicks. A startup CFO could move $10 million from SVB to JP Morgan in 30 seconds from their laptop. No bank visit required, no physical check, just electrons moving through the Federal Reserve's payment systems. The venture capital ecosystem is small and tightly connected. Founders talk to each other constantly. VCs coordinate. When Founders Fund, Peter Thiel's firm, advised portfolio companies to pull funds Thursday morning, word spread instantly. Group chats lit up. Email forwards circulated. Twitter amplified the message. Within hours, every VC in Silicon Valley knew Founders Fund was pulling out. Other VCs followed immediately. Coatue Management sent withdrawal advice to portfolio companies. Union Square Ventures did the same. Founder Collective advised founders to move funds. The coordination wasn't a conspiracy. It was rational self-preservation happening simultaneously across a network of professional investors who all talked to each other. By Thursday afternoon, the panic was total. Startup founders who had never worried about their bank's stability were frantically initiating wire transfers. Companies with 50 million, 100 million, 200 million at SVB, all trying to move money out simultaneously. Depositors attempted to withdraw $42 billion on Thursday, March 9th. That's 25% of the bank's deposits in a single day. For context, a normal day might see a few hundred million in withdrawals. $42 billion was apocalyptic. SVB didn't have $42 billion in cash. No bank does. Banks operate on fractional reserves. They keep a small percentage of deposits as cash and invest or lend the rest. SVB's cash reserves were around $13 billion. The bank was instantly insolvent. SVB tried desperately to raise cash Thursday evening. The bank contacted potential buyers, other banks, private equity firms, anyone who might inject capital or acquire SVB. But 48 hours isn't enough time for due diligence on a $212 billion bank. Nobody would commit without examining SVB's books thoroughly, and there wasn't time. By Thursday night, SVB's situation was hopeless. The bank couldn't meet withdrawal requests. Regulators knew SVB would open Friday morning unable to return depositor funds. That's the legal definition of insolvency. Friday morning, March 10th, before markets opened, California's Department of Financial Protection and Innovation seized Silicon Valley Bank. The FDIC was appointed receiver. SVB was closed. Depositors who had accounts under the FDIC's $250,000 insurance limit would get their money back. Depositors with balances above that limit, which included nearly all of SVB's startup and VC clients, faced uncertainty. Their funds were frozen while the FDIC figured out how much could be recovered. The panic was immediate and total. Silicon Valley's startups couldn't make payroll. Companies had millions or tens of millions deposited at SVB and couldn't access funds. Venture capital firms faced potential losses on fund accounts. The entire tech ecosystem was paralyzed. But the contagion spread beyond tech. Depositors at other regional banks started questioning whether their bank was next. Signature Bank in New York, which served crypto companies and real estate firms, faced a massive run over the weekend. Signature held $110 billion in assets. By Sunday, March 12th, regulators seized Signature too. 2 major bank failures in 3 days. First Republic Bank, a San Francisco-based lender, faced withdrawals exceeding $70 billion in the days after SVB's collapse. First Republic would eventually fail in May 2023, becoming the 3rd largest bank failure in U.S. history. The regional banking crisis SVB triggered lasted months. When the London gold pool closed in March 1968, there was no warning. Investors woke up and the market was locked. No gold available, no conversion. Done. We created the 7-stage collapse survival guide so you never get trapped when the window closes. It shows you exactly when to move your wealth into assets that survive collapse. before banks freeze, before governments confiscate, before inflation devours your savings. While you can still access it at https://pay.hotmart.com/B1033628817E. The government response was swift and unprecedented. Treasury Secretary Janet Yellen, Federal Reserve Chair Jerome Powell, and FDIC officials worked through the weekend. By Sunday evening, they announced emergency measures. All depositors at SVB and Signature Bank, regardless of account size, would be made whole. The FDIC's $250,000 insurance limit was effectively suspended for these failures. The decision was controversial. The FDIC insurance limit exists for a reason. It's supposed to encourage depositors to spread funds across banks, reducing concentration risk. By guaranteeing all deposits at SVB and Signature, the government was rewarding the very concentration and lack of diversification that made the banks vulnerable. Moral hazard intensified. Critics pointed out that SVB's depositors were venture capital firms and wealthy tech companies, the least sympathetic victims imaginable. Why should taxpayers backstop Silicon Valley elites who failed to diversify their deposits? The government argued that allowing uninsured depositors to lose money would trigger systemic panic and destroy regional banks nationwide. The FDIC's Deposit Insurance Fund would cover the guaranteed deposits through special assessments on other banks, not taxpayer money directly. But the principle remained. The government stepped in to prevent losses. The Federal Reserve also created a new emergency lending facility, the Bank Term Funding Program, allowing banks to borrow against their bond holdings at par value rather than market value. This directly addressed the unrealized loss problem that killed SVB. Banks with underwater bond portfolios could access liquidity without crystallizing losses. The facility prevented other regional banks from facing SVB's fate. The interventions worked to stop immediate contagion, but they revealed uncomfortable truths about the banking system. SVB wasn't an outlier. The unrealized losses on bond portfolios existed across hundreds of regional banks. The FDIC estimated that U.S. banks held over $600 billion in unrealized losses on securities at the end of 2022. Interest rate risk was a systemic problem, not an SVB-specific failure. SVB's collapse exposed multiple regulatory failures. The bank had no chief risk officer for 8 months leading up to the failure. SVB's risk management was notoriously weak, and regulators knew it. The Federal Reserve had flagged issues in supervisory letters but took no enforcement action. SVB grew from $70 billion to $212 billion in assets in less than 4 years, and regulators allowed it without requiring stronger risk controls. The speed of the collapse, 48 hours from distress signal to seizure, was unprecedented for a bank SVB's size. Previous major bank failures took weeks or months. Bear Stearns lasted a week from crisis to acquisition. Washington Mutual's failure in 2008 followed months of visible deterioration. Lehman Brothers' collapse came after months of attempts to find buyers. SVB died in 2 days because of digital banking and venture capital network effects. Depositors didn't need to physically go to a branch and wait in line to withdraw funds. They clicked a button and initiated electronic transfers worth millions instantly. $42 billion in withdrawal requests processed Thursday required no human interaction, just panic spreading through Slack channels, Twitter, and VC memos. The venture capital concentration made coordination easy. In a normal bank, depositors are dispersed individuals and businesses making independent decisions. At SVB, depositors were a small network of VCs who communicate constantly. When major firms like Founders Fund advised withdrawals, the signal propagated instantly to every other VC and every portfolio company. Coordination happened in hours, not days. For regulators, SVB was a wake-up call about digital bank runs. The traditional playbook for managing bank crises, arranging weekend sales, injecting emergency capital, coordinating with large depositors to prevent panic, doesn't work when $42 billion can flee in a day. The speed of electronic banking makes traditional crisis management tools obsolete. The aftermath for Silicon Valley's tech ecosystem was severe but brief. The government guarantee meant startups got their deposits back within days. Payroll processed, operations continued. But the trust was shattered. Companies diversified deposits immediately. SVB's unique position serving half of venture-backed startups evaporated. When the remnants of SVB were sold to First Citizens Bank later in March, it was a fraction of what SVB had been. For SVB's shareholders and bondholders, the losses were total. The stock went to zero. Bondholders faced severe haircuts. Executives who had sold stock in the weeks before collapse faced accusations of insider trading, though no charges were filed. The bank's CEO, Greg Becker, had sold millions in SVB stock weeks before the failure, raising questions about what management knew and when. The broader lesson from SVB is about hidden systemic risks. The unrealized losses on bank bond portfolios were visible to anyone looking at financial statements. Analysts had flagged the interest rate risk. Regulators knew the problem existed, but nobody acted until panic forced the issue. The assumption that depositors wouldn't run, that withdrawals would be gradual, that banks had time to manage through. All those assumptions collapsed when digital panic hit. SVB's failure proved that in the age of instant electronic transfers and tightly networked depositors, a bank run can destroy a $200 billion institution in hours. The old rules about bank stability don't apply when deposits can vanish at the speed of a Slack message. And the unrealized losses that killed SVB still exist across the banking system, waiting for the next trigger, another rate hike, another inflation shock, another panic. The Federal Reserve faces a dilemma. Raising rates to fight inflation creates unrealized losses that threaten banks. Cutting rates to help banks risks reigniting inflation. The SVB collapse revealed the bind central bankers face. The tools used to manage the economy can destroy the financial system, and the interventions to save banks can undermine economic policy. For depositors, SVB's lesson is clear. The $250,000 FDIC insurance limit is real until it isn't. The government guaranteed all SVB deposits, but that was a crisis decision made to prevent contagion. In a less systemically critical failure, uninsured depositors might not be rescued. Assuming the government will always step in is dangerous. Diversifying deposits across institutions, keeping balances under insurance limits, and monitoring bank health are necessary in an era where digital runs can kill banks instantly. SVB's collapse also demonstrated the limits of diversification in interconnected systems. Tech startups thought they were managing risk by banking with the industry expert. SVB understood their business, provided tailored services, connected them with investors. But that specialization created concentration risk. When SVB failed, the entire ecosystem faced paralysis simultaneously. The thing that made SVB valuable, deep integration into venture capital, became the mechanism of its destruction. The speed at which SVB fell shocked even seasoned bank crisis veterans. FDIC officials who had managed failures during the 2008 crisis said they'd never seen anything like SVB's collapse. The $42 billion in withdrawal requests Thursday exceeded the total deposits of most regional banks. Processing that volume of transactions in a day would have been impossible a decade ago. Digital banking made it routine. March 10, 2023, marked the second largest bank failure in American history, behind only Washington Mutual in 2008. But while Moo's failure followed months of visible deterioration, multiple capital raises, and failed acquisition attempts, SVB went from appearing healthy to insolvent in 48 hours. That speed, the compression of crisis from weeks to days to hours, is the new reality of banking in the digital age. The collapse reminded everyone that banks are inherently fragile institutions built on confidence. When confidence breaks, no amount of capital or liquidity can save them if depositors want their money back all at once. SVB held over $20 billion in cash and liquid securities Thursday morning. But faced with $42 billion in withdrawal requests, the bank couldn't survive. The math of fractional reserve banking means no bank can withstand a full-scale run. Silicon Valley Bank's failure was a warning. The conditions that killed SVB, unrealized losses from interest rate hikes, concentrated depositor bases, digital panic spreading at the speed of social media, exist across the financial system. Regional banks remain vulnerable. The Federal Reserve's emergency lending facility prevents immediate crisis, but it doesn't eliminate the underlying problem. Interest rates remain high. Bond portfolios remain underwater. The next panic trigger could come anytime. This is Decoded Economics. Subscribe to see the collapse before it happens.